some people will have access to deferred comp plans. So that's another way to look at deferring money. If you're a highly paid person, usually executive level at your company, you can take a section of your money and put it into a deferred comp plan. Now you have to really like your company, because if the company goes out of business, that's not your money anymore. The money goes to them. That's how the IRS set all that stuff up. So you have to be. So you're a creditor
of the company.
Yes.
And if you already have, RSUs or stock options or pension, then you're really a creditor of the company.
Correct. And if the company is sold or merges with another company, then that account will be paid out to you. Welcome to the Wise Retirement Podcast, and we believe the best financial advice should always be conflict-free. I'm your host, Casey Smith, guiding you to financial freedom. Today is my co-host, Shawna Theriault.
Morning.
Good morning. How are you?
Awesome. How are you?
Great. So we've been really growing as a firm. You're a regular now on the podcast.
I feel like I am.
It's like episode, is it 3 times in a row now? Something like that?
Something.
Yeah, we've got... Missy's out this week on vacation, but we have all these new people in the office now. I think so. I guess what our listeners don't always know, because forget I'm talking on a podcast here.
Right.
So on Mondays, we typically don't have client meetings. We start off with a marketing meeting with myself and Hadley and Alexa, and then we roll into a company-wide meeting, which is about 45 minutes. And this is where Tiffany yells at us all for
not doing
something.
The operation stuff.
So basically we have CRM software that tracks all the open tasks, and they have deadlines.
Yeah.
So if you go over your deadline, then she sees that. She's like, hey, why haven't you done this? Why haven't you done that? So we go through this operational kind of a
checks and balances.
Yeah,
I like it.
It's not really a standing meeting. We're all sitting, but the idea is that, hey, let's just get through our day. And then we, after that, we go to lunch. So it used to be a long time ago, we'd go down to one of the restaurants on the square, and it kind of got where, we kind of ate all the square food, and then this market opened up and people can get their own food. And there's probably 12 different restaurants in there.
Mm-hmm.
So we would sit at these really long benches. We would take up half a bench. And then yesterday when we went out for lunch, even with Missy gone,
and Rachel was out yesterday.
That's right. Rachel was not with us yesterday. Yeah. We took up a whole bench plus 2.
Right.
So 2 of us had to be, set to the side. I volunteered for that because I know nobody else would feel like they were left out. But yeah, we took up a whole bench like that. We have 13 people now. Isn't that crazy?
Yeah, that is crazy.
From all various educational backgrounds now.
Yeah. So
we have Missy from Wake Forest. We got, Grace just started. She came out of Georgia Southern.
She did.
So we have, Andrew's Georgia Tech. We've got
UGA
with William, Sanford with Michaela. So we've got quite the SAC covered, and private schools on top of that, and I guess the ACC too. And then after we finish lunch every Monday, we come back and we break up into groups, and so Alexa goes and works with operational people about goals and things we're working on, and then all the advisors come in and planning associates, and we go over every single plan we're going to deliver that week.
Yep, absolutely, as a group.
So it's a group effort as we go through this. But anyway, I just reminiscing, because there was a time period when not that long ago that there were maybe 5 here, and at one point it was just me, Tiffany, and Alexa for a couple of years.
Right?
Yeah, a couple of years. So it's
exciting.
It's exciting. A little anxiety, I guess. Payroll looks a little different these days. But it's all good problems. We're probably adding 4 clients a week, somewhere in there, 3 to 4 clients a week.
Yep,
so
yes,
growth is good, and I love the new people that are coming in, and then we have legacy clients that have been here for 20 plus years, and with a 99% client retention ratio. So I think things at Wiser are really good.
Well, it allows us to help more people too.
Oh yeah, absolutely.
So that's great.
Absolutely. It's
give really good advice for them.
And then my whole thing is just hire people that are smarter than me. So it's amazing how, if you take that approach, what kind of a team you can build, where I feel like a lot of our business is there's some egos in our industry.
Yeah.
And
I think that's in every industry.
well, probably, but
Yeah.
a lot of people just want to be the top dog, and I'm not.
Well, a good leader, will entrust their people to, hire them for what they're good at and
Sure.
allow them to do it.
Yeah.
So it's surrounding yourself with people that have different, different skills than you do potentially, or enhanced, or work well with them. So
True.
yeah,
Very true.
Absolutely.
And being willing to let go. I think as a business owner, it's really hard to let go. I remember when I let go of my finances, I was like, I don't want to give this to you. I feel like you're just like looking into my underwear drawer at this point. But I've been told if I don't do this, I won't be successful. And that's true. I don't open up QuickBooks other than at tax
I wonder
time.
if prospects feel like that too. Clients coming in, it's
Oh.
like we're just,
That's
taking
true.
over their, looking at.
That's true.
Sometimes it's, you're nervous to show because it's like, I know I spend too much. And you're going to tell me that.
There's a couple of families I know that I know they always carry credit card debt, but yeah, they pay it off because I say savings hasn't really gone up much. I know you guys are working on building your savings, and then I see, oh, well, they paid off their credit card right before they came in because they didn't want me to see that. So
Yeah.
there are only a few families like that.
Yeah.
But yeah.
Well, it's more like a coach position, right? We're just trying to help them and
Oh,
bounce
yeah.
ideas and inspire.
We've seen everything. And I always tell people, I was in my 20s one time. We all make mistakes.
Yeah.
We all do stupid stuff.
Yeah.
No judgment.
We all have
And I don't care how we got here. You're here and we're going to move forward. I don't care what's
Doesn't
happened in
matter.
the past. That doesn't matter.
No.
So people are harder on themselves than other people are.
Well, and that's where it's like objective, but also what I love about the firm is the heart of the firm and caring about people. It's really about the people and helping them versus
Absolutely.
growing the firm. That's it's about.
Well, the firm grows because our heart's in the right place.
Exactly.
Yeah, that's what I don't understand. I've been asked a couple of times to. There's a couple of other companies we're really close with, and say, "Hey, can you come in and take a look at this particular process? We're not succeeding like your firm is." I was like, "Sure." And so I get on the phone, and I have all these people in front of me, and I know within 5 minutes what the problem is. It's the heart.
Yeah.
People
The
don't want to
focus
be
is
sold
wrong.
anything. People want to know that you care.
Right.
And you have to hire people with the right heart. You can't really change someone's heart. So much of our industry is like, what can I sell them to make X amount of dollars for myself? And I learned a long time ago, if you put yourself before someone else, you will never be successful. It'll be a dead end after dead end after dead end. Now there'll be false success. You'll succeed for a while.
Yeah.
But you're going to realize that it's empty success. And when you get to the other end, you didn't change anybody's life. You didn't do anything to make them better. In the end, all you did was put a lot of money in your pocket at the expense of someone else. And I'm specifically talking about the annuity salespeople and the life insurance stuff. Now, there's a place for all that, but not here.
Yeah.
That's not the environment that I wanted to build.
No.
And so it took me a while to figure it out though. Because I kept, why is this person not working? Why is this person not working here? It's like, oh, you got to figure out what the heart is. And you have to figure out how to do that over 3 interviews.
And the hiring process, which
and you
is
got to
hard.
ask the right questions, right? And so that's been my journey, is like, how do I figure out what people?
Well, I can tell you, I have never had an employer or prospective employer ask me, "What is your story?" Ever.
Yeah, I remember you told me
at that. I was like, wow, like he actually wants to know about me, not what are your skills? What are you? No, what is you? And that was amazing. That was amazing. So I was like, okay.
Well, I'll tell you what, people listening, if there's like an apocalypse or something, like a zombie apocalypse, like I'm with Shawna because she's a badass.
Thank you.
She's gonna come out guns blazing.
Guns blazing. No, if there's a problem, we'll have it handled. I don't know that I would hurt anybody. I don't know. I'm not about the violence, but I will definitely figure out a solution.
No, you have grit, and that's what I saw, and that's what we need. We need as a firm is we gotta to push through this next level of what we're gonna have to do. We're gonna need some grit, and we're gonna need to take some young people and teach them the ways and bring them along. And that's hard. Anybody out there who's running a business right now, if you're hiring anybody in their 20s, just God bless you. It's a whole different world.
They're so smart though.
They're
so smart. They're smarter than us. They are.
Maybe in their 20s, if you could find that one.
Right.
If you can find that one. I've gone back to I think we've been successful in that phase just because of, again, finding people that want to have a sense of purpose.
Yeah.
So it's, if
I've had so many people, I've had so many people and leaders and, people that have just jumped in and helped me over the years and taught me the ways. Yep. And, starting the industry at 18, I just had so many people, mentors that I sought them out. It wasn't like they just came to me. It's like, teach me, how do I handle this? And, I've had so many people help me along the way, and that's what we do, right? We learn and we grow, and then you turn around and help the person behind you always. Like that's what you should do. Yeah, absolutely. What's the point of holding on to information and not helping other people come up to that? Well, in a bad work environment, yes, where everything becomes very territorial, or very much of a silo. That has never been who I was. Well, some firms are built that way. You have like a team of 2, and then that's it. You don't pass off any information. Right. You versus them. Where we're trying to build an environment here where it's always one big. We're on the same team. Yeah, we're in the same boat. Exactly.
Are you curious why annuities keep coming up as a potential investment option? People are often told that annuities can effectively mitigate investment risks and help secure their financial future. However, annuities often benefit the salesperson and might not be the best choice for you as a consumer. To learn more about the various types of annuities, the negatives of owning them, and better investment alternatives, we have a free ebook on our website just for you. To download our ebook, Buyer Beware, Why Do They Keep Trying to Sell You That Annuity? Simply click the link in the episode notes or visit wiserinvestor.com/guides. Now let's get back to the episode.
So let's go ahead and hop into our actual topic today. How can I reduce my taxable income? So I think this is a question we get quite a bit from people, and I have a little bit of bad news. Is if you're a business owner, we have a different podcast, or not podcast, but we have a different episode that covers a lot of that from the past. But if as a W-2 worker, there's not a whole lot. We do have a checklist for you that you can kind of go down and work on. Yeah. So I'll let you, you're the CPA. I'll let you start.
Well, there's really nothing exciting about it. And we feel like we talk about it all the time. It's, deferring to your 401k. Yeah. That's important. I mean, if you're doing a Roth, that's not going to give you a tax deduction now, but it just depends on meaning a Roth 401k.
So let's talk about that for a second. So there's a point where you have to decide pre-tax or Roth.
Right.
So I've always thought, and you correct me if you think it's different, but I've always thought that if you're younger, it's pretty much almost always going to be Roth. So if you're under 30, almost always Roth.
Yeah. Well, I think it's based on income.
Yeah. Well, okay. Yeah, but I don't know. If you're 60 years old and making under 100,000, would you still do a Roth? You probably still do pre-tax.
I do pre-tax in that situation. Probably.
So I think it's aged is almost always Roth, but then there's a point at which you get over a household income of, I used to say 300,000. Maybe it's still there. Then you do want to put everything pre-tax.
Yeah.
But whenever you hit the 34% tax bracket.
Yeah. And that depends if it's single or joint, obviously.
Well, correct. So, yeah. I'm assuming married.
Yeah, exactly. I don't, if it's like 300, 400, I like to defer because it's saving the taxes now.
So there's other advisors out there. Specifically, I'm talking about our airline people. There's 2 that want to put everything into Roth no matter how much money you make. And I keep running my Excel spreadsheet on that, and it doesn't work.
Yeah. No,
it doesn't work. I'm like, why are they recommending this? Because if you put money into the Roth and you have high income, then if you're in the 37% tax bracket, you're taking a 37% hit on your dollar. And then that means the Roth has to go make 37% to get back to break even. Then after that, you're in the bonus.
Bro.
So if you're in the 12% tax bracket, that's a pretty easy hurdle to get over, but not at the 37% bracket.
Right.
That's why you want to do everything pre-tax. And if you're making that much money, you should be able to do pre-tax. You should be able to save additional money into a brokerage account.
And the backdoor Roth, probably.
And you could do backdoor Roth. You could do the mega backdoor Roth where you're putting money after tax money into the plan and then converting it into a Roth. You could do an individual backdoor Roth by putting it into an IRA, not deducting it, and then converting it to Roth. I'm talking really fast. People are like, what is he talking about?
Well, we just did a show on this. Missy and I did a couple weeks ago. So you can go back and look at that.
You can listen to that episode. But the point is that if you put money to a brokerage account, when you retire at 65, you don't have required minimum distributions until age 75. You have a whole decade that you can figure out how to convert from IRA to Roth. In the meantime, for 20, 30 years, you've been able to defer that tax as long as possible to use that 37% that you would have paid in tax to then grow more money before you have to pay the income tax. So anyway, that's just, I'm getting on my soapbox on that, but I'd call him out if I can remember the guy's name. It's the Pilot Advisor, I think, is the company. I know that's the company. But their whole thing is, don't pay tax, and he really pushes this whole, the government's going to get your money, and this, I've always joke and say pilots are like borderline preppers, right? So so they just buy into this stuff, and I'm like, no, guys, it's a math problem.
Yeah,
just solve the math problem, and every family is going to be a little bit different,
right,
than another family. There's not one piece of advice I could give you
that fits for everybody.
That fits for the 400 people that are going to listen to this episode, right?
Yeah.
So it depends on your situation.
Completely.
But yeah, if you're making a lot of money, max out your 401k pre-tax.
Yeah. And you can also do a health savings account if you have the high deductible healthcare plan. So that gives you a tax deferral now. A lot of clients will use that for retirement expense, the healthcare and retirement. So allow that to grow tax deferred.
My only caveat there is if you'll look at your plans that are offered. It could be that if you're a high user of healthcare, that the HSA is not the best for you. You really do need the PPO.
Yeah.
So just be careful. I would say tax is a secondary to the health. So make that decision very, very carefully. But yes, an HSA, I have an HSA. I just know every time I go to the doctor, it's going to cost me $500. But I don't use my HSA to pay for it.
Right.
I'll let the HSA grow. Right. And eventually I'll invest, the balance, because I just started mine. But when I get to a certain point, I'll move that money over and invest it. But don't use the HSA. Just use it for tax deferral. Let it grow to pay for your premiums in old age. Yeah.
Yeah. That's a great strategy. Then if you do have a PPO, your employer may offer an FSA.
Flexible spending account.
Right.
That's the one that expires at the end of the year or near the end of the year.
Yeah. You have to use it within like a few months after expenses for the year before. Right. That's up to $3,200. So that's tax deduction.
If you have kids in daycare, that's another one.
Yeah. Yeah.
If your employer offers
it.
Yeah,
absolutely. Absolutely. It's been a while since I've had that. Then most clients don't even itemize anymore because the standard deductions are so high, but you still have those itemizations. And so you have charitable contributions of cash and property.
Yep.
So that's a deduction that you can look at. Your interest on your home, the state and local taxes. So, state taxes like Georgia, we're in Georgia, other states. But there's that limitation now of 10,000 that they've really, capped everyone out on that. But you can still look at the timing of your deductions too. And this was bigger. I feel like this was bigger when you could deduct all of your Georgia tax and you could deduct all of your real estate taxes when it was above the 10,000. You would look at the timing of that, and maybe move some of those deductions, not pay
that's not applicable anymore.
It is. You can still do that. But because of that $10,000 limitation, I just feel like it doesn't come into play that much.
Yeah. So what she's talking about is if you're going to owe Georgia tax, you would prepay that in the current tax year and you could deduct that on your federal tax.
Right. Exactly. And itemize that.
But
and so
after 2017, it's harder to do that.
It is just because of that 10,000 limit, because it looks at all of your state tax and your real estate taxes and any local taxes. And so you're just capped at 10,000 and most people are over, especially if you're higher income, you're over that 10,000 threshold and you can't use it. So, medical expenses can fall under that as well for deduction. So, looking at that, And I know we recently did on capital gains, we did that whole show on capital gains. And so harvesting those tax losses and having a brokerage account that is tax efficient, that's a way to save money on your taxes as well.
Mm-hmm. So you can write off $3,000 a year in capital losses.
Right.
And in a brokerage account with this much volatility that's happening in the market right now, especially if it's professionally managed, you should be taking advantage of these major swings.
Yeah.
And it doesn't mean you're timing the market. It just means you're selling out of the S&P 500 by State Street and you're buying the S&P 500 by Vanguard. It's the exact same underlying holdings for the most part. And you can write off that loss in that transaction. And then if you have typically over $200,000 in your portfolio assigned to large caps, you can do what we call direct indexing.
Right.
And that you can really generate some taxable tax credits that way.
Yeah.
That will carry forward to future years. So that's very important. Unfortunately, most firms aren't doing any of that, which I don't understand. How can you be an asset manager and these firms don't even hardly do financial planning?
Right.
And they just tell people, oh, just invest for the long term.
Yeah.
And they're collecting a fee. And I'm just like, what are you doing for that fee? Like you should be tax loss harvesting the account.
Yeah.
That covers your fee. Right.
Well, and that's why you do the direct indexing, because if you're just owning, back to your example of owning the S&P 500 and selling it and buying another, it's not always down, but the underlying holdings in the index could be down. And that's why you can do the direct indexing. On the direct indexing.
Correct.
Right.
Correct. But if you're putting money in every month, like
right.
the money I put in my brokerage account last month right now probably
down.
doesn't look so good.
Right.
So you could sell that and then you could buy something similar, which, we have a program we call, it's called Flight Path. It's an automated investment platform. So we use it for our hourly clients because it allows them to self-direct, but it helps them with exactly this in that it does tax loss harvesting automatically for you.
Yeah.
And it does rebalancing automatically for you. Yeah. And so I have an account there just like everyone else does. And the computer just makes those trades when it sees the opportunity. You don't have to really think about it.
Right. So you're not having to manage it, if you will.
Correct. And the savings account's 5.5% still, which was pretty exciting. So there's a lot of positive things there. But anyway, I digress.
Well, they took away a lot of the deductions that we used to be able to use on our tax return, exemptions, personal exemptions, things like that. I mean, there are still some tax credits depending on, most of the individuals that ask us these questions are in a higher tax bracket. How can I save money on my taxes?
Yeah.
There are still, the child tax credits. There's other credits out there that you can utilize depending on what tax, if you're in a mid to lower tax bracket. But most individuals who are wanting to save money on taxes are in the higher tax bracket. There's not a lot that you can do to offset your taxes. And the good news is that you're making money though.
Yeah.
So if you're paying taxes, you're usually making money. So that's good news.
So I would add a couple other things to our list. Some people will have access to deferred comp plans. So that's another way to look at deferring money. If you're a highly paid person, usually executive level at your company, you can take a section of your money and put it into a deferred comp plan. Now you have to really like your company, because if the company goes out of business, that's not your money anymore. The money goes to them. That's how the IRS set all that stuff up. So you have to be
So you're a creditor of the company.
Yes.
And if you already have, RSUs or stock options or pension, then you're really a creditor of the company.
Correct. And if the company is sold or merges with another company, then that account will be paid out to you. So I had this happen a long time ago with an insurance executive where they were doing deferred comp, putting a lot of money in there. This is great. He was pretty high up in the company, but he didn't know about a merger that was quickly announced. And so he had a $3 million payout from his deferred comp plan in 1 year.
Yeah.
And I did the math and he still came out slightly ahead, but it wasn't nearly as what we thought. Because originally he's going to put all this money in, he's going to take it out over 10 years once he retired. So you could defer that, right?
Yeah.
So you just, there's some downsides to it, but that is an option that sometimes people have. They don't realize it. They have to ask about it.
Right.
So that's another thing. And then non-working spouses, you could do a spousal IRA.
Yeah.
You should be able to deduct that. Yes.
Yes. Depending on if you have a 401k and if yours is deductible.
Correct. So that could be another avenue for non-working spouse putting money into an IRA.
Yeah.
Or if you don't have a 401k for some reason, you can put money into an IRA regardless of what your income is.
Yeah.
If you don't have access to a 401k. So that's another way. Trying to think of,
I don't know. There's always options too. I've seen options, especially at smaller companies where, and it just depends on the dynamics, where if your bonus structure, there's sometimes your employer will let you push bonuses to future years or, delay bonuses to do that. Obviously that depends on the company. If they need the deduction for so usually that's a planning for the owner, right?
As a business owner, I would argue that that would hurt the business owner.
That would hurt the business. It depends. Yes. So at any rate, I've seen that before too. I just know we've had clients mention it even in bigger companies where it's like, well, you can elect what year you want it. So that may be an option as well.
Right. True.
Mm-hmm.
There's, in Georgia, it's still a thing. It's not as prominent as it was, but these movie credits.
Yes.
So that's a legitimate thing. You can purchase movie credits, and basically, let's say you buy $10,000 worth of movie credits that might be worth $13,000 or $15,000 worth of credit.
Right, towards your Georgia
tax return. So you can lower your Georgia tax by doing that. These land conservation stuff, stay away from that.
Yeah, those are under scrutiny and they're clawing back. I know I've seen them before where when you buy into these, they had insurance tied to them so that if they were ever audited and disallowed, that the insurance would cover the taxes that you owe them back. But they're all my understanding is that a lot of them are blowing up and clawing back on the taxes on that.
Smaller accounting firms that have managed to get every client audited because they put this in almost everybody's account. And the firms probably wouldn't exist anymore because of it. So it's just very dangerous.
Yeah.
I wouldn't participate in anything like that. But I think the big thing is there's no smoking gun that it's not going to get you audited.
Yeah.
You can start, most people say, I want to start a business so I can write off these losses. And I translate that to mean I want to start a business to write off my life. So you have to be able to generate income.
Right.
If you're running a legitimate business and it hasn't shown income yet, but you think it will, then that's fine.
Yeah. Well, you have hobby loss rule there that can come into play.
Yeah. If you start a business, but it never makes any money.
Yeah.
Right.
Yeah, exactly. Then it's not really, it could be considered a hobby.
Correct. So, which means you'll have to go in the past and redo those returns and get rid of that loss.
Yeah. Well, and it's, it's like the whole goal here is to create wealth or, create options and lifestyle and whatever it is your goals you're trying to achieve. And so I don't know that I would start a business to try to save taxes, especially if it's going to cost you a lot. Like, what is it actually costing you? Does that make sense that you're pouring money into a business that you could be investing just to save tax? Like you don't want to make decisions just based on the tax ramifications. Yes, you want to understand the tax ramifications and make sure, is this the best use of this based on the whole picture or the return of what I'm doing, whether it's real estate or this type of investment. You want to understand the taxes because that is an important piece of the total return.
Right.
Or, reduction in the return, but I wouldn't make, because is it still costing you and leaving you with less money to save tax? That doesn't make sense to me.
No. And sometimes you just got to pay the tax. And what happens is people make $100,000 a year and then all of a sudden they start climbing the corporate ladder or going up in their seniority at the airline or whatever. And now they're making 300, 400, 500,000. And they go, oh my gosh, all this tax that I'm paying is ridiculous.
Mm-hmm.
And yeah, that's how it works. It's a progressive tax system.
Right.
So if you're in the 37% bracket, your whole thing's not getting taxed at 37. It's much less than that.
Yeah.
But just your top dollar is getting taxed at 37%. And it's a good problem to have. And I don't want to be nonchalant about it and say you shouldn't
pay
do
your
anything,
tax.
but at the same time, you can get really creative and try to save money on tax. And you're also going to get yourself audited.
Yeah.
And that's going to be hell.
Yeah. That is hell. And then, are you really growing your overall net worth?
Because you probably don't have receipts for half that stuff.
That's true.
Right.
That's true. That's true. And they have been understaffed for many years, but I feel like they're beefing that back up because I've heard of more and more audits happening.
Yeah, absolutely. So those are things that You just don't have to put your family through. So to me, it's black and white. If it's in the gray area, I wouldn't do it. I wouldn't go invest in something to write off losses on, meaning, these LLCs and business ideas and stuff like that. So now if you want to go invest in a business and you want to grow that business and to be something, but you have losses for the first few years to write off, that's fine. Yeah. But not as a purpose. Right. to lose money.
Agreed. Completely agree.
All right. Anything else?
I don't think
we
so.
got it.
I think
we covered it. It's really that simple, y'all. It's not. You can have a creative accountant. That's a thing, but you're asking for trouble. People every now and then I get questions like, "Can I deduct my clothing? Did I have to wear a certain type of clothing to work, and I wouldn't normally wear that." No. No. Now, I think if you have to wear a uniform that you'd be embarrassed to wear somewhere else, that's probably a tax deduction, but not your everyday clothing. No, you can't write that off. Okay, so episode 229, How to Avoid Capital Gains Tax, is one we did recently. The YouTube channel, A Wiser Retirement, Can Donor Advised Fund Reduce Income, Taxable Income? That's the one we probably didn't cover as much, being charitable. That would be a good tax deduction too. But you're giving it away. You're not building wealth with it, obviously. Right. Different type of gift, I guess.
Different type of wealth, right?
Right, exactly. How to reduce taxable income as a business owner. I encourage a lot of people to listen to that one. That's out there on the YouTube channel. Anyway, thanks for listening. If you're interested in learning more about Wiser Wealth Management or want to talk to one of our fiduciary financial advisors, you can do so by going to wiserinvestor.com. And please remember to like and subscribe anywhere you listen to this podcast. It really helps us grow our audience. Thanks so much. See you guys next week.